There's a question here on the screen, franchising for you limited. Franchising for you limited markets a range of franchises. See, this question is basically, I hope you are able to see the question on the screen.
Yes, ma'am.
Missed. See, this question has one section about Maximax, Maximum, Minimax regret, but there are other bits also included. See, apart from that, we have to look at calculate the NPV. NPV, which you have already learned in FM. See, earlier papers, this was already done. So we can directly take it up doing NPV. Then talk about what is intellectual capital. As part of integrated reporting, we've learned about 6 different types of capital. Financial capital, manufactured capital, intellectual capital, human capital. Then we see sixth one. The sixth one is natural capital. Uh, Something to do with relationships. I don't know the term. I'm not able to recollect. Um, see, to have the relationship with others, whatever is the social and relationship capital. I'm sorry for that. Social and relationship capital. So out of that, so the out of 6 capitals, there is one bit asked about intellectual capital. We have done integrated reporting in the previous classes, so we can take up that question. Then the question says that CBIT says that discuss ways in which reliance solely on financial performance measures can detract. Actually, we have not started with performance measurement measures, but it's not that you're completely unaware of that. So I will discuss there when we come to CBIT. I have selected this one basically because it is discussing about Maximax, Maximum, Minimax regret. So on that note, let's take it up this one and then answer this question. I'll put this one in the Excel sheet. We'll read through the content. No, from there only we'll read the content and then we'll come back here because that font is and that view is bigger. So we'll read from the PDF file and then go back to Excel sheet. Franchising for you limited, F4U, markets a range of franchises which it makes available to its customers. The franchisees. F4U supplies the franchisee with information of the mode of operation, detailed operation schedules, and backup advice by telephone, internet, and undertakes national advertising. Each franchisee must arrange for its own premises, equipment, and undertake local marketing. F4U is considering the introduction of a dance and drama franchise, which would have an expected life of 6 years. From this project, the only income F4U will receive from franchisees comes from the initial franchise project, franchise fees. The following estimates have been made relating to the cash outflows and inflows for F4U in order that F4U can evaluate the financial viability of the dance and drama franchise proposal. Initial investment of 6 million. This will include a substantial element relating to the intellectual capital requirement of the proposal. Development or improvement costs of $1 million per year at the end of each of 2 years, years 2 and 3. 300 franchises will be sold each year at a fee of 20,000 per franchisee. Variable costs payable in full on the issue of each franchise are estimated at 6,000 per franchise. Directly attributable fixed costs of 0.6 million per year in each of years 1 to 6. No further fixed costs will be payable by F4U after this period. Corporation tax at the rate of 30% payable in the year in which cash flow occurs. Tax allowances are not available on the initial investment or development improvement costs payable by F4U. All cash flows are stated in current prices and with the exception of the initial investment will occur at the end of each year. The money cost of capital is 15.44%. Annual inflation during the period is estimated at 4%. Calculate the NPV for the first bit. Talk about intellectual capital. Dependence on financial performance measures. Is it justified? Then take up all these things. Okay, let's start. We'll go to the Excel sheet and then work it out. First, let's note down certain points, very important points. Let's note down. First thing, we see initial investment of 6 million is there. Initial investment relates to 0 year. That all of us know that. Then later on, they also spent, apart from the initial investment, they also spent 1 million per year at the end of each of years 2 and 3. Second year and the third year, they would spend 1 million per year. Third bit, it says 300 franchises will be sold. So it is about the revenue. 300 franchises will be sold each year at a fee of 20,000 per franchisee. Find out what's the revenue. Fourth one, it talks about the variable cost is estimated at 6,000 per franchisee. Fifth bit says that directly attributable fixed cost of 0.6 million per year. So we have the fixed cost also given to us. Sixth one talks about the tax rate. Corporate tax at the rate of 30% payable in the year in which cash flow occurs. Tax allowances are not available on the initial investment or development improvement cost payable by F4U. Seventh one says that all cash flows are stated in current prices and with the exception of the initial investment will occur at the end of each year. The money cost of capital is 15.44%. Annual inflation during the period is estimated at 4%. The money cost of capital is 15.44%, but the inflation rate is at 4%. So we need to include that and then estimate, see if there was no mention about inflation there, then we would discount the cash flows at 15.44%. But then because the inflation is also given, they are stated in the current prices. So we have to include the inflation, find out what is the real cost of capital. So the formula for real cost of capital, I'm just writing it here. What's real cost of capital? Is equal to, we have in the numerator the nominal cost of capital, that is money cost of capital, money cost of capital plus 1 divided by 1 plus the inflation rate. From the entire fraction minus 1. So here we see 1 plus 15.44. So the calculated value here in terms of percentage is, it's 11%. So 11%. So the cash flow should be discounted at 11%. We have a time period of, see for how long this there would be benefits out of this proposal. The initial investment of 6 million, FOU is considering the introduction of a dance and drama franchisee, which would have an expected life of 6 years. So we have to include all that for a time period of 6 years. The calculation of NPV. So we have come to the point of calculation of NPV. So let's start with, first it is year. Year would be from 0. Next, there's some initial investment. Then after that, they are also spending some development costs. After development costs, third point is about revenue, franchisee fees. So it's about revenue. Then we see fourth point is variable cost. Fifth point is fixed cost, directly attributable fixed cost. So the next one is fixed cost. Then we have tax rate. So first let's fill these details, then we can think about tax rate and the other aspects. So the initial investment is 6 million. 6 million will be a minus figure. So we see 6 followed by 6 zeros. That is initial investment. Development costs are not incurred in the first year, but they happen at the end of second and third year. So which is 1 million. This is also an outflow. They are incurring these development costs. So second and end of second and third year. Next comes revenue. See, what is the revenue? Third bit says 300 franchises will be sold each year at a fee of 20,000. Is equal to 300 into 20,000. Next comes variable cost. The variable cost is 6,000 per franchisee. How many franchises? 300. So is equal to 300 into 6,000. Fixed cost is also there. Fixed cost says it is 0.6 million. So it should be 600,000. So 600,000. So all through 1 to 6 years. 600,000. After that, okay. So tax is there. Tax will be calculated on profit. So first we need to know what is profit. So how do we find out profit? Profit is equal to revenue minus variable cost minus fixed cost. So all total costs are deducted and then we would have what is profit. So find out what is profit. Then we need to know what is profit after tax. That is profit after tax. How do we calculate? See, the calculation would go like this. We have profit into 1 minus tax. So that is profit after tax. What's the tax rate? The tax rate is 30%. So the profit is equal to profit 1 minus 30% is 70%. 1 minus 0.3 is 0.7, 0.7 is 70%. So this into 0.7. This is profit after tax. Are you with me? Did you understand till here?
Yes, ma'am.
Okay. So once we get what is profit after tax, the capital budgeting techniques, among them, only ARR depends on profit after tax. The rest of the 4 techniques in all their variations, they depend on cash flow after tax. So cash flow after tax is profit after tax plus depreciation. But we did not do anything about depreciation. Do you think we have to do depreciation, calculate depreciation? What is cash flow after tax? Profit after tax plus depreciation is cash flow after tax. I hope you remember that part. We didn't do any depreciation. Should we be including depreciation? What's the concept here? The depreciation is calculated only on tangible assets. The wear and tear value of tangible assets is called as depreciation. See, if it is natural resources, we call it as depletion. See, if it is um, intangible assets, then we call that to be as amortization. Okay. Um, Here in this case, it is basically initial investment. This will include a substantial element relating to intellectual capital requirement of the proposal. So this is not amortized intellectual capital. So they are acquiring the intellectual capital. Therefore, there is no concept of depreciation which has to be calculated here. It is not property, plant, equipment that depreciation would be calculated. So now we have profit after tax. So profit after tax becomes the base. These profit after tax figures have to be discounted at the rate of, just now we've calculated the real cost of capital percentage, which is at 11%. So I'm slightly moving this little this side so that I can accommodate one more column here. Okay, so we need to know what are the, how do we calculate? We need to take what are the table values. See, from the table values, we can take PV factor at 11%. At 11%. We need to, I mean, they would be provided, you would take it from there, but I see, I don't have the tables. I mean, I can take it from the internet also. Let's write the factors. I hope you know how to calculate. 1 divided by 1 plus k whole to the power of n. 1 plus k is 11%, whole to the power of n. N is here. The same thing would be um, find out the PV factors. See, cash flow is not just one cash, but cash outflow is not only one cash outflow, but cash outflows we see that they happen in 3 years. One is in 0 year, another one in second year, then also third year. So in that case, what are we to do? We also have to find out what is the net cash outflow. See, we have the cash inflows, the profit after tax is available. We should also know what is cash outflow. So we need to know both of them. Just find out what is cash outflows. Not net. Just write cash outflows. In 0 year, this is the cash outflow. We don't have anything in the first year. Second year we have second year, and the third year also we have. So first, let's find out what is present value of cash outflow. Then we'll find out what is present value of cash inflows. Done. So present value of cash outflows. The next column, let's find out what is present value of cash inflows. Find out the total. Then comes present value of cash inflows. What is NPV? NPV is equal to cash inflows minus cash outflows. You know that. NPV is equal to so you can just directly take this. So this is a positive figure. I don't know how do we read this. 31 lakhs 18,142 or 300 no 3,118,142. So it is a positive figure. So the project can be accepted. So that's the calculation part of it. So NPV, we got a positive figure, so the project should be accepted. So it's a 6 marks question. The numerical calculation, though it took a lot of time, but it is not. Given a lot of weightage here because the analysis part of it, advanced performance management is basically more to do with the analysis, not more to do with the calculation part of it. So we've done that. The conclusion whether it should be undertaken, yes, it should be undertaken because it is a positive figure. So it ends there. That's a 6 marks question. The next 6 marks is about intellectual capital. So let's focus on what is this intellectual capital. B bit says, discuss the elements to be considered as intellectual capital and issues associated with its valuation for inclusion in the initial investment of 6 million. What would be there as part of intellectual capital? Let's focus on that part of it. What's intellectual capital? It is about employee knowledge, their skills, their ability, their caliber, etc. So to acquire that, they had to spend that initial investment of some amount. So they had to spend an initial investment of 6 million. Sorry, 6 million. Now, in the second question says that what element should be considered as intellectual capital? What do you think are part of intellectual capital? What do you think are part of intellectual capital? There is not much answer. Not a lengthy answer. The crucial answer. What basically? See, when we are talking about intellectual capital, the intellectual capital is basically about. Here we see there is one simple example given as employee knowledge. Okay, so explain that. See, intellectual capital is basically about the employee knowledge, skill, caliber, abilities, technical know-how. See the knowledge about the employees, etc. How do we value that? The issues with associated with its valuation for inclusion in the initial investment. See, to know the value of these abilities, these skills is a difficult thing. Can we assess that and then measure that in terms of monetary value? That is not a simple task. That is a difficult task. So that is the issue which is associated with the valuation of intellectual capital. Basically, what is intellectual capital? First explain. Intellectual capital is about intellectual capital includes. So in detail, you explain that. What does it include? We see that skills are there. abilities are there, know-how, knowledge is there, caliber is there. So explain that. So basically, intellectual capital means what? The question also talks about the issues in valuation. If we talk about issues in valuation, is it easy to value intellectual capital? Is it easy to value intellectual capital? No, it's not easy to value intellectual capital. One second. See, issues in valuation is difficult to find the value, difficult to assess the value. They want to include see the substantial amount element relating to the intellectual capital requirement of the proposal. So how much would be to what extent um, would they be showing this intellectual capital as an asset in the balance sheet? No, there is a difficulty in assessing that. It is not an easy task to assess the intellectual capital. So that is the main issue. Concept wise, see, when we look at the explanation what we have written here as NPV calculation and intellectual capital, it is a small concept, but see that is, see, you should know about it. One small concept about what is intellectual capital, it is an important thing. Unless and until you are aware of what that is, you will not be able to talk about it. You should first know what are the different types of capital, then know what is the meaning of intellectual capital. Why is there an issue with intellectual capital? Because it is not easy to calculate intellectual capital. So therefore, um, okay, that is an issue in terms of valuation of valuation of intellectual capital that can be included in the initial investment. So that is how you have to explain that. Then it is talk about it is an intangible asset. Um, okay. Um, acquiring acquiring these employees with that kind of caliber is an issue. See, they are not easily available. Then, to what extent they should be spending on acquiring these employees, etc. So, those aspects are also part of intellectual capital. That is what you have to explain there. Then we come to the crucial point, what we have discussed in today's class about risk and those strategies. The question relates to that one. We discuss ways in which reliance solely on financial see is there. See, then in that case, I think we cannot take up fourth question. Let's see. CBIT says discuss ways in which reliance solely on financial performance measures can detract from the effectiveness of a performance management system within an organization. Oh, sorry about that. See, the question says discuss ways in which reliance solely on financial performance measures can detract from the effectiveness of the performance management system. To measure the performance of an organization, the usual procedure is about measuring the performance with the help of financial parameters. Like we take the financial statements, we take um, the profitability aspect, the revenue part. See, calculate the profitability percentages, ratios, and then know whether the firm is doing well or not. So measure the performance by way of financial parameters, financial performance indicators. So that's a regular procedure. That's a common way of measuring the performance. But then it is also important to include non-financial performance. See, um, the complete picture of the organization cannot be depicted by way of using the financial parameters. So there are non-financial performance indicators or performance parameters also which are important. See, like the relationship with their stakeholders is important. The stakeholders like customers, whether the customers are satisfied with the business or not. What kind of relationship do they have with the suppliers? Are they reliable? Do they promptly supply? See, that also indicates about whether they are doing well or not. The customers are satisfied. Yes, that talks about the success of the business. Then they considering the quality aspects of it. They talk about customization, flexibility. They talk about safety measures within the organization, the processes which they follow, the procedures which they have in place. The satisfaction of the employees, on the other hand, that is important. The way there is governance in the organization. So these are all not quantified. They are not measurable in terms of money, but yet they help in assessing the performance of the organization. These factors also talk about whether the organization is doing well or not. Success is not always measured in terms of the profit margin. See, some firms may have lower profit margins. Their financial performance is not very attractive, but yet they are successful businesses because their customers are satisfied with them. They have good relationship with the stakeholders. They have the support of the government. Okay, their employees are satisfied with them. See, various aspects. They are keen on providing quality products to their customers. The quality is given utmost importance. They may in terms of the customer base, they may have the highest market share. Okay, those parameters are also very important for a business to be considered as successful. But the common practice of measuring the performance of organizations is by way of using financial parameters. Are you able to follow? Please answer me. Are you able to follow?
Yes, ma'am.
See, the common measure is using the financial parameters, but it is also important uh, in which reliance solely on financial performance measures can detract. See, it is not the only way in which the performance can be measured. Detract from the effectiveness of the performance management system. So we need to explain about what are the non-financial parameters, and using them we'll talk about the complete view or the picture of the organization. It is possible to assess the organization in a holistic manner with the help of both the financial and the non-financial performance measures. So we need to explain that, and then this is also for 6 months. So you need to first understand what are the and what are the non-financial parameters. See, there are advantages of. In fact, actually, let me put you to a slide. That's little later that we would be doing this, but because the topic has arisen, I'll take you to a particular slide and then we can look into What are the non-financial performance indicators? Somewhere we should have that. Sorry for non-financial performance indicators. Like I was mentioning about the customer relationship with customers, suppliers, satisfaction of customers, satisfaction of employees. Um, then the quality aspects of it, safety measures. These are all also indicate whether they are doing well or not, whether they are successful or not. See, what is the point in including non-financial performance indicators? There are advantages and disadvantages. Advantages talk about, see, they are easy to calculate. See, people can easily understand whether I mean the aspect about somebody customer satisfaction, what are the safety measures, what is the number of defective units produced, what is the quality aspect of which is maintained. Such kind of things are easy to understand, but financial analysis based on the financial figures are not very easy to understand by many people in the organization. Some of them, even in their senior positions, also cannot understand numbers, cannot understand the numerical analysis, financial analysis which is taken up. There are various tools which are used, so it's not easy to understand for many. But this kind of non-financial measures and their calculations are easy to calculate and easy to understand, and then they are provided quickly understood by non-financial people, less likely to be manipulated. So those are the advantages. Disadvantages are, see, when we are giving a scope, when we are putting a focus on non-financial parameters, there is a possibility that financial aspect is not given much importance. But see, other things are important, but similarly financial aspect is also important, so that cannot be ignored. Cause too much of information it would be when we focus on non-financial parameters. There are many things, so that would result in information overload. Then pursuit of operational goals may blind managers to overall strategy. So they may not be focusing on the operational goals, but um, very much bother to look at the other aspects of the organization. Let's go back to the Excel file. So you need to discuss ways in which reliance solely on financial performance measures. So that is not the only way the performance can be measured, but there are other non-financial performance measures also which have to be taken into consideration. That will give a holistic view of about the organization. So they are easy to understand, calculate. Many can understand all that aspect. So those things need to be discussed. So you need to first have an idea about what are the non-financial performance measures, non-financial performance indicators. So those things you need to first give a reading about the list of non-financial parameters along with the financial performance indicators. These things also will help in assessing the performance of the organization in a better way. So that is what you have to explain there, talk about it, and then do it. Okay. Now comes the So I don't know whether we can finish this one, but let's see. Let's give a reading and then we can take it up in tomorrow's class also. It says that F4U has identified key variables as follows. The number of franchises taken up each year. It is estimated that a flexible the number of franchises taken up each year, it is estimated that a flexible pricing policy will result in the following outcomes. We see there are three different price. They see that there are three different pricing prices for the franchise. If it is 22,000, they would be able to sell 270. If the price is lower to 20,000, the number of franchises will increase to 300. Then if it is lower to 18,000, 355. So there are three different possibilities which are presented here. That information is given. The variable cost for franchise is, so there are three different variable costs also anticipated. One variable cost is 7,000, one is 6,000, one is 5,000. This is the information. Three different revenues, three different variable costs. So three different number of franchises also. That is the information given. Second bit, it further says, considering three different revenues, that is 18,000, 20,000, 22,000, and the three variable costs of 5,000, 6,000, 7,000, they have done the NPV calculation. NPV calculations are calculated. That is, if revenue is 18,000, variable cost is 5,000, what is NPV? If revenue is 18,000, variable cost is 6,000, what is NPV? So like that, they have provided the NPV. So 3 by 3, 9 possible NPVs are already calculated and provided. Okay, done. That part of it is there. We have 9 different NPVs calculated for 3 different revenues and 3 different variable costs. That's the information. Then it says that state the franchisee fee pricing strategy which will result from the operations of each of the following decision rules. So the decision rules are, if Maximax is followed, Maximin is followed, Minimax regret is followed. Okay. Maximax Maximin will do it. Minimax regret rule will do it tomorrow because time will not be sufficient. Maximax is the question is, what should be the franchise fee? We have to go with the franchise fee. So if the franchise fee is so what should be the one? Whether it should be 18,000, whether it should be 20,000, whether it should be 22,000. So that is what has to be chosen. Alternatives are given. So we need to look into the alternatives. First, select all the maximum returns. The Maximax talks about select all the maximum returns, and from among the maximum returns, then again another maximum value will be selected. Basically, that is Maximax. If the fee is 18,000, then there are three different options. That is, NPV could be at 5,000, at 6,000, at 7,000. When we see that, there are three different NPVs. Among them, which one is the maximum? This is the maximum. At 20,000, then again we see this one is the maximum. At 22,000, which one is the maximum? So they go with selecting the maximum. From among the maximum, select the maximum. Maximax. There are two parts in that. Maxi, one part, first part, second max is the second maximum. So second one talks about the maximum returns. After we select the maximum returns, from among the maximum returns, again go with the maximum. So I'll write it here itself. If we talk about Maximax, at at 80,000 piece, NPVs, we see it is 4,348,226. Then we see at the second one is 22,000, 20,000. Then the third one is 22,000. So what are the fees here? 4,630,000. Then we see 4,274,183. So among them, which one is the maximum? This one is maximum, isn't it? Okay. If this is the maximum, so they should decide on the fees of 18,000. So the decision is state the franchise fee pricing strategy. So the pricing strategy will go with deciding a price of 18,000 because at 18,000 NPV is the maximum. Okay, how did we arrive at that? First, we have chosen about we have looked into what is the NPV at different price structures. At different price strategies, what are the NPVs we have looked into, and then first selected what is the maximum NPV. So round it up, all of them. Among the maximum NPVs at different pricing strategies, from among them, which one is the maximum? So that comes out to be at 18,000. So the price of 18,000 would be decided. Is $18,000. Okay, let's end here, but I'll take the attendance first and then um, did you understand till here in today's class?